Hello, everyone. I'm Chris Pollock. Thank you for joining me again. I hope you've all had a good week. I'm still in the middle of mine. I'm away at a presentation in India on Friday, so this has been recorded on Thursday. If there's been an emergency Fed rate cut on Friday, and I don't talk about it, that is why. But there's plenty we can learn from the week, as has been already, starting with what we said would be a big day, PMI day on Monday. Look at this data. There is not an ounce of positivity, whether you're looking at the big hitters in Europe, France, Germany, or the UK, nor in the US. I mean, there's a little bit of hope in the US service sector, which continues to surprise moderately to the upside, but everything else is looking pretty shaky here. For those of you who aren't familiar with PMIs, anything below 50 is contraction. So we're getting some hefty contraction in the German manufacturing PMIs. These figures we've seen obviously in COVID, but we're nudging horribly towards these sort of levels that we saw right back in July of 2023. Accelerating any further lower than this, then we're going to be looking back to COVID levels of contraction, which would be trouble. So yeah, real weakness. This is a leading indicator for GDP, so worth bearing this in mind as we go forward. And yeah, perhaps this leads on quite nicely to why we've seen I would argue is potentially the most significant news of the week, which is the Chinese pledging of more stimulus on Wednesday morning. They raised rates and to increase stimulus, and they're now on Thursday considering injecting up to $1 trillion of capital into the state banks. This is because the scope of proposed measures were deemed or were questioned whether the scope was sufficient, but the newly announced fiscal stimulus appears to have soothed the concerns. This is one of these cases, as they say, of the tail wagging the dog, the market telling the central bankers what to do. Giving us some stimulus? No, sir, that's not enough. We need more, please. And in they come a mere 12 hours later. A big aggression to the upside in risk assets when this happens. If the market likes it, which they seem to be doing on Thursday morning. Interested to see how this unfolds as we roll forward, because we've also, to kind of circle back, in the last half an hour or so, we had some news out from ECB sources. Is kind of like a little tip-off from the ECB players, where they speak to some journalists who then report to the market. If I can scroll down, I'll be able to dig it out for you. Stuff here. This was out 9, so hopefully it'll be long to find this. Here we go. ECB doves are to fight for an October rate cut after weak data. Well, the weak data being the PMIs that we've seen, and they're now to fight for the rate cut. This news even on TweetDeck, and if you want to learn how to get all these news feeds through for free, please reach out to me on my Twitter handle, which I'll talk about in a moment. But the time that this came out was at 8:53. If you want to see what happened to the market at 8:53, you were still given plenty of time to get into this. Here is 8:53. 8:54, you can still be scratching your backside. As long as you're in before 8:55, you managed to catch what was a pretty nice move on news. They say news moves markets, and this was one of those prime examples. And you had a 2-minute heads up with even these free news sources, not even the more expensive ones that we tend to use in here. So if you want to get access to these free ones, please reach out to me and DM me on Twitter. But that's, I think, going to be something that unfolds or the market pays close attention to over the next little while. The PMIs that we had in China, I think, are going to be interesting. Why? Because looking to the week ahead now, Chinese manufacturing PMIs hit the wires first thing Monday morning. We look back to the prior, we can do it from here, in fact. We're seeing a decline in these PMIs similar to previous declines where they've stepped in, and lo and behold, for 5, 6 consecutive down months on PMIs. We haven't had 7 downs consecutively for a long time. So very curious to see what these numbers print on Monday. With the stimulus coming in, I don't think you have to be a genius to think we might be a little bit lower there. Forgive me having recorded this a little early. We do not have the forecasts yet for most of these, but over the weekend these will all appear, so you'll be what the market is expected to see. The Chinese PMIs, I think, will be super important on Monday. We do have German data inflation data. A lot of this comes out at 9 o'clock. The big German national one at 1, but we pretty much know that beforehand with all the regional inflation pieces that we get through. We can probably identify this a little bit clearer on a different calendar if you'll follow me through. So if I go to the next week, we get to German data. Why is it not giving me? Let's try again, pop the filters away and see if we can find, oh, it popped me on bonds. So let's look like clicking the wrong buttons here and go back to regular inflation data. So let me pop this on the UK time because they always like to put me closer to buy 4 hours earlier. Let's see. I'm going to find my way back home. Here we go. So certainly from London time, we're talking about 7 o'clock for the import prices and retail sales. But yeah, 9 o'clock UK time, we get the Baden-Württemberg CPI, Bavaria region, Brandenburg, Hesse, North Rhine-Westphalia, one of the big ones, Saxony, all out at 9. So 9 o'clock's really when you get the main numbers, and then you get the headline CPI at 1, but you kind of should know or then what is likely to be going. Yeah, 9 o'clock on Monday UK time. Also, we're hearing from some of the central bankers. Fed Chair Powell back on the wires. You can't keep the man down at the moment, but this is a participation in a moderated discussion. So this may well be one of those where Fed Chair Powell does not discuss US monetary policy remarks, and in which case volatility probably won't grow on that. But if he has a chat with someone at a party, that can move markets sometimes. So whenever he's available, you want to be aware of this. But before we get to 6 o'clock, something else is happening. This is the last day of the month. In fact, it's the last day of the quarter. Month end is one of the most consistent trades in here. How do we do it and what happens? Let's chat through. So I'll refer to some data from Brent Donnelly, an excellent market analyst, big trader at a lot of big banks, runs Spectra Markets. So please feel free to reach out to them. They send these weekly updates out completely free of charge, and it's very interesting. Or some of them I find incredibly interesting. This one, I wasn't using it to understand what happened on Friday the 13th. I'm more interested in how the S&P has a win percentage based on the day of the week and the date of the month. Also, forgive Brent's formatting here. This particular day of the month finishes here. He's just copying this from the one below. So ignore this area here. This 31st is this line. There you go. So you'll see end of the month, last couple of days, these don't tend to be particularly strong. And we'll get to why in a moment. By contrast, you mirror that to the beginning of the month. This is the best day of the month. Right, a 73% win rate if this is a Friday. Goodness. That's the sort of consistency we like as traders, right? But why is this happening, I hear you ask? And the answer is pension funds. Everyone who is employed, certainly in this country, is paying into a pension. You're paying into a pension, you are buying stocks, effectively. Your money finds its way to a pension fund manager. They open their computer first day of the month. They have an extra $50 million they need to invest in the markets. Bang, some of it finds its way into the markets. More buyers than sellers, often, not always, which is the market up. And this consistency is seen by this aggression that we get on the first day of the month, even the second, third, fourth, you would argue, only maybe wanes by the fifth. So the beginning of the month tends to be strong due to this influx of funds from pension. Right? So month end, why does it do the opposite? Well, pensions are not just an accumulation of wealth from people investing into pensions, are they? Some people luckily have retired, and they're drawing money out of pensions. They are drawing money out of pensions. They are needing to sell stocks, or more accurately, their pension fund managers are needing to sell assets from the market, and that puts downward pressure on the market in the last couple of days. Certainly the last day of the month is when we tend to focus on this the most. But obviously not all months have 31 days, right? So some of those 30ths are the last day of the month, which is why this is reflected well in here. But having said that, the market often, or certainly the FTSE, often rallies in the morning, and really it's by midday into the afternoon, the market sells off. And those last 2 minutes before the market closed, please watch what is 4:28 UK time to the close at 4:30. The markets often have sort of aggressive selling wrapped up in there. So if you want to trade month end, this is what this office will be jumping for month end. It always is. One of the easiest and most consistent trades that we do. If you want to find out more specifically about how we trade it in detail, again, please reach out to us. For the remainder of the week, we've got month beginning starting on the 1st. More buyers than sellers. Markets tend to go up. But more interestingly for me, the start of, well, two things. We've got PMIs, ISM manufacturing PMIs. This is a survey done by the Institute of Supply Management to work out what purchasing managers think. And just to kind of put these in perspective, the What Moves Markets discussion paper done by the Bundesbank. Feel free to reach out to get hold of this as well. The page that I often refer to when talking about news releases, page ominously 13, which is tell us which are the most volatile news events. We'll talk about the US employment report later, but the US ISM releases are the third most volatile event historically for stock markets and bond markets. That comes through on typically the first day of the month. Manufacturing PMIs are getting that done for us at 3 o'clock UK time on Tuesday. This also with manufacturing prices, which is an inflation number, right? We're seeing something that is a growth figure and an inflation figure simultaneously. So as we mentioned, I think last week, if you get strong growth or views of growth and you get weak inflation, then that's probably the perfect storm for stock, vice versa. But if you get strong PMIs and strong prices, this is more likely the perfect storm for gold, for the dollar. So please be aware and pick your markets wisely when you see this data released. To add some confusion, we also have JOLTS data, some jobs numbers thrown into the mix, also at 3 o'clock. So it's likely to be a busy time on the first day of the month. Rolling into Wednesday, more about oil, really. We've got OPEC meetings, we've got oil inventories. These ADP figures are important. And we do have bond auctions, actually, a German bond auction, and in the small hours of the morning, a Japanese bond auction, I think on Thursday as well. There's some Spanish and French bond auctions. Be aware if you're trading the euro or the yen around those times. But the ADP figure is something that I probably don't care so much about these days. This is a private company that tries to predict the Non Farm Payrolls figure, the number in a moment. Leading into that Thursday, with CPIs, okay, yeah, we like trading that. Unemployment claims, the weekly jobless number as always, but we also get more ISM PMIs, this time the service side of the equation. And I think we do have bank stress tests in the UK. I need to find the day for that one. It was, I believe, middle of the week. Here we go, UK bank stress test on the Wednesday. I mean, they're going to pass the stress test, you would have thought at this stage, but at some point they may not. And if they don't, this is going to be a big old shakedown. So worth being keeping your ear to the ground with your news feeds on Wednesday with regards to that, just in case. Very much an outlier, a 1 in 30 chance, probably less of a move this time. But in the end, that 1 in 30 chance will play out, and it will pay out. The ISM services figures, again, 3 o'clock UK time on Thursday. And then we go into the biggest news event of all, the average hourly earnings, the non-farm employment change, and the unemployment rate. Always the first Friday of the month, unless Friday is the first. And then they pop it to the second. They don't have time to get the data. But just to kind of remind you from this, the US employment report, all those things in it, is by far the most volatile event for stocks. Okay, the auctions are important for bonds, but for US stocks and European stocks, these are the biggest volatility events on the US calendar. So very much worth tuning in. We are getting inflation numbers. The average hourly earnings measures wages, and wages are sticky. And unlike commodity prices, inflation, when oil prices can go up and they can often come back down again. Think of the Ukraine war. We spiked from $90 to $130. Now we're trading in the 60s handle again. So commodity prices can go up and down. That creates inflation and deflation. Wages, however, they go up and they stay up. If you get a pay rise 1 month and your employer comes around to you to give you a pay cut the next, you'll have some choice words for them, I'm sure, and your wages will remain the same. Non-farm employment change. So this is the headline figure that we've often cared the most about in my trading career over the last 18 years. In fact, didn't really care too much at all for average hourly earnings until a couple of years ago. So this typically has been important, and it will be important again, but don't overlook the unemployment rate. To Months ago, we broke something called the SAHM rule, SAHM. SAHM rule is when the average of 3 months of unemployment rates, they average this to try and smooth out any outliers within those 3 months of data. Whenever that average of 3 months is greater than 0.5% and a low within the last 12 months, go back to August, 3.5. Then we got this average in August of over 4s, over 4.1. In fact, this triggered the SAHM rule. And that suggests the SAHM rule says with pretty strong certainty that we will see a recession. And if these unemployment figures continue to look ugly, that will continue to bang that drum. And maybe we'll be talking about stimulus and deeper rate cuts in the US. We seem to be hitting a bit of a precipice on rates at the moment. And the Swiss central bank rates again at 9 o'clock on Thursday morning this morning. So we are very much turning the corner on this. And the sort of reasons we would like to cut rates are things like your PMIs looking shaky or your job market looking very ugly indeed. So watch these numbers next week. It's always a big week, the start of the month. We are rolling into a new quarter. The last quarter of the year typically is often the best quarter for trading long stocks at least. So do be aware of this changeover and how you can capitalize from it. And if you do want to find out more about how we trade these markets and how you can capitalize on the sort of moves we saw on the euro earlier from that trigger at 853 down to these lows, or whether it be month end, how to trade news events, please reach out to me at C Volume Profile on all. Thanks for joining us. Have a wonderful week, and I'll be back with